Welcome to the Planet MicroCap Podcast, the #1 destination for everything microcap investing. I'm your host, Robert Kraft, and each week I sit down with elite investors, CEOs, and market experts to uncover actionable insights and real-world lessons you can apply immediately. Are you a new or experienced microcap investor? Do you want to meet microcap management teams as well as other microcap investors from around the world? Planet MicroCap hosts the highest quality in-person microcap events in North America. The mission is to bring the best microcap investors, companies, and allocators together to gather, connect, and grow. Visit planetmicrocap.com to learn more about our Las Vegas and Toronto events. Now, a quick disclaimer. The purpose of this conversation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. Planet MicroCap Holdings LLC and Microcap Club LLC are not registered investment advisors. Planet MicroCap Holdings LLC, Microcap Club LLC, its partners, contractors, members, subscribers, guests, and affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security. In this episode of the Planet MicroCap Podcast, I'm joined by Artem Fokin, founder and portfolio manager of Caro-Kann Capital, to reflect on more than a decade of running a concentrated small and microcap strategy focused on finding multibagger opportunities. Artem shares how his bottoms-up approach centers on deeply understanding a handful of businesses, engaging thoughtfully with management teams while maintaining the discipline to stay objective, what he calls being friendly, but not friends. We also discuss why due diligence should extend beyond the CEO to the entire leadership bench, why microcaps remain one of the best training grounds for investors despite structural market changes, and how avoiding intellectual rigidity while embracing tools like AI for research can help investors continuously adapt and improve their decision-making. We mentioned a number of companies today, not too many, but the ones that we did, I'm not a shareholder in any of them. And with that, please enjoy my conversation with Artem Fokin. Artem, thank you for joining me today. How you doing, man?
Hi, Bobby. It's great to be back. Good seeing you.
Good to see you. You know what? This is becoming our annual tradition. You know, at the beginning of the year, the flowers are blooming. Everyone's excited, you know, in some ways, shape, or form. And I'm just very happy to always have a chance to catch up with you on how the year was, what you're excited about, what you're jamming on in terms of ideas. But before I even say anything, congratulations. I wanted to wish you a happy anniversary on your fund. It's 11 years now, right?
Correct. March 1 is 11 years. So technically, we're recording on March 3rd. So it's 11 years and 2 days.
11 years and 2 days old. Do you feel like you've learned a lot in the 2 days since you've turned 11 years old?
Those 2 days, it's really what counts.
It is.
It's all about exponential learning and second derivative, right?
Yes, this is very true.
And
It is all about it.
compounding.
Yes, it's all about compounding over 2 days versus 11 years. Like, what was 11 years when we have the last 2 days to actually truly reflect on
Truly
everything that's
reflect
gone
and
on?
compound your knowledge. Exactly.
Exactly. Well, look, even though you've been on the show multiple times now, I think, geez, I'm going to draw a blank on when my first interview you for the podcast. But I also thought this would be a good opportunity for you for those that haven't heard you either on Planet MicroCap or on all the other amazing podcasts that you've been on over the years. Can you give us that quick overview of who you are, as well as a background on the fund's strategy and philosophy?
Sure. So, as you probably hear, I grew up in California. That's why you hear this Californian accent. Mostly Northern California, North Bay Area. Okay,
They're called the northern part of California.
Northern part of California, exactly.
Yeah, right.
People, you guys in the South, you speak a little differently. You have a different accent than I do. So
Yes, exactly.
I was born in former Soviet Union and grew up in Russia. I came to the US in 2004. So it has been 21 and a half years since I came. And in my prior professional life, I was a lawyer. The way I describe it, when I was very little, I was an attorney in New York City. So I was a member of the New York Bar. That's how I came to the US to do my Master of Laws at NYU. I worked for about a little less than 4 years in New York City at Big Law, doing mostly international tax structuring. And then I went to business school in 2009 until 2011. I graduated and then I entered the investment world. I worked for another hedge fund here in the Bay Area. And in 2015, on March 1, as you already mentioned, of 2015, I launched Caro-Kann Capital. I invest mostly, it's a bottoms-up investment style. I invest mostly in small and microcap companies, though not exclusively. I aspire to have a concentrated portfolio of names that I know very, very well. And I believe our first podcast with you, when we were one-on-one, not in a group setting, but one-on-one, I believe you called it hunting for multibaggers. So that's still the same philosophical approach. I want to find companies that could become multibaggers. It doesn't mean that all of us succeed. There are plenty of mistakes. It doesn't mean that all of them become such multibaggers, but that's the goal and that's what I aspire to do.
Very good. Thank you for that full background. And I'm going to throw it's not even going to be a curveball. It's going to be a slider. Okay. Because there might be folks listening in that have either done a one-on-one meeting with you before in management teams, and maybe some folks that, recognize you, and just, it's cool to have the opportunity to even see you on one of these things. I just have to ask, what are some of your favorite questions that you like to ask management teams when you do go to investment conferences like mine, and, you're doing your 50 one-on-ones and all that kind of stuff? I'm kind of curious, because I'm also curious how your question set has maybe evolved over the years since starting the fund, 11 years ago.
If I tell you all the questions I like to ask, then next time when I come to Las Vegas in June 2026, by the way, on behalf of Bobby Kraft and Planet MicroCap and Microcap Club, I would like to invite everybody to come to Vegas. It will be a great event. I always like coming to those. By the way, this is not a paid promotion on behalf of Bobby. Bobby, I'll send you my invoice later on. Don't worry. I'm joking.
Absolutely.
But it's a great event. I love coming there, and thank you again for running this for many, many years. But if I tell you now the questions that I like to ask, then every management team that I meet, if they do a quick Googling or ask ChatGPT or their favorite LLM about what this manager asks, then they will have a great answer. So I'll give you one that I like asking when I don't know much about the company. And I start with, what pain points do you solve for your customers? What's the reason for your existence? And I think the answer will be very telling, because it's not only me obtaining information, but also seeing whether management is customer focused or not customer focused.
I think that's a great question to ask them, regardless of how long you've been doing this. So if you're very new to the game, add that question to your list of questions. So main reason I wanted to invite you on here is, as I said, it's an annual conversation that I like to do, kind of reflecting a little bit, talking, things that you've been jamming on as well. But first off, 2025, it's in the rearview mirror. It seems like that was already 10 years ago. But from your perspective, how did 2025 go for you? What were some of the things that worked, and what were some of the things that didn't?
Looking back, 2025 was a good year. Now, an annual period is always incredibly arbitrary. It's only 1 year. And there is always lots of noise. Now, it's always better to have positive noise than negative noise, but it's still noise. So I think, for me personally, I'm a lot happier that I've been doing this for 11 years, because it takes 11 years to build 11-year track record. Now, with the caveat that past performance is never necessarily indicative of the future results, and there are always risks involved. There is including big risk of loss, etc., etc. But that's 11 years doing this. That's what I feel a lot better about. Now, in any single year, anything could happen. And as I said, it's better when positive things happen than negative. And generally, a recipe for a good year is to have few big winners. The more the better, the more the merrier, and avoid big losers. And by big losers, what I mean is a big position that declines substantially in value. Because if it's a small position and you got the thesis wrong, or you got unlucky, that's highly unpleasant because it may be down 50% or more. But if it was 2% position or 3% position, it's not going to really kill you or destroy your year. What really gets you if you have a big position and then it goes against you. So if you avoid those losers, chances are you will have either a decent year or a very good year.
Did you find yourself reallocating to ideas that were already positions, or did you find yourself finding a lot of new ideas, or maybe some ideas that were already on your watch list that now became more interesting at the valuations they were at?
I think it's a combination. I think it will be difficult to split that exactly. We got some new positions in the portfolio in 2025. For some of them, I'm quite excited going into the future. Some of them will be at your Planet MicroCap event in June. So look forward to seeing them in person, because some of those management teams I only met on Zoom. Some I might have met in offline as well, but some are only on Zoom. So I'm excited to see them in person. They're still in the portfolio. If the management team executes, I'm hoping that we'll be able to have them on the portfolio for many years.
So for those companies that are currently in the portfolio, unless they're coming to an event like ours, what are some of the things that you'd like to discuss with management teams when you're there? And just wanted to really, I mean, I know that's a general question when I know each one is probably very specific in terms of the types of question sets that you're asking. But what are some of the things that you're curious that you want to see when you've only met a management team via Zoom and now you're going to meet them at a conference and wanting to get a better take on, how they operate, how they're talking the talk, whether they have been walking the walk, all that kind of stuff?
During one-on-ones, and as you pointed, I do plenty of them, I don't think my questions will be radically different from what I would ask on a Zoom meeting. I don't think my script or my agenda changes. Where there is a change is potentially at social events, whether it's a cocktail reception or lunch break or something. And often there will be groups of people standing and chit-chatting, including investors, including managers. And this is, I think, a great time to ask and talk about very soft things that you may not necessarily have time to talk about during your very structured 25 or 30-minute meeting. For example, it's interesting to learn how leadership style of a specific CEO got formed and became the way it is today. I will not mention a specific company, but CEO of that company worked in several regions in Europe. And it's just really fun to talk to him, how his leadership had to change depending on each region, because there are cultural differences and you need to adjust. On a podcast of our mutual friend Andrew Walker about something else, I used an analogy from golf, and I don't even play golf, but Andrew told me that it's a great analogy and it was accurate, so I'll try to pull it off again.
You're helping me learn golf right now too. This is great.
Okay, maybe both of us learn.
I was never a golfer. I know my grandfather tried to teach me, and I was always a baseball player, so I couldn't. I always felt like it was going to mess up my swing.
Got it. So think about leadership style.
Totally not interested.
Think about leadership as playing golf. And depending on the context and people you're leading, you may need to use different styles, same way as you would be using a different club when you're playing golf. And learning those softer things in largely social setting of chit-chatting at a cocktail party or something like this, that's a lot of fun, and it's very valuable to know, to understand the leadership team better and how they view the world, and more importantly, why they view the world the way they do.
This is a topic that we were jamming on right before we hit record, and back at last year's event, you did an awesome conversation with Andrew Walker, friend of the show, yet another value pod, one of my favorites out there. And this was something that you said that you wish you'd covered there, but we'll talk about it here. And it's very appropriate in talking about one-on-one meetings, talking with management teams, doing that kind of deep dive due diligence. In your opinion, what's your feeling about relationships with management? Some investors become almost friends with management. Would you say that's a good thing or a bad thing?
I don't know whether it's a good thing or a bad thing. I think it's a dangerous thing. Then it's up to you to decide whether you want to take the danger or not. So I don't want to be friends with management. I want to be friendly. I want to have a good, respectful dialogue. But I'm worried about becoming friends. And I think the reason why I'm afraid of that is because there's no way you're going to win. Let's say your portfolio company is not performing. Being friends with management would likely blindside me in objectively evaluating the lack of execution, which may require to make an exit decision, sell the position, and move on. You also probably are less likely to press management and hold them accountable when you discuss with them the strategy or what they're doing or why over the X number of years XYZ happened and something else didn't. But then you can push me and say, okay, what about when companies execute well? Isn't it fun to be friends with management in that case? Revenue is going up, number of customers going up, happiness of customers going up, profits are going up. Probably, most likely, stock will fall. Isn't it fun to be friends in that case? And I'll say no, because at some point you still may need to sell the company, and because it approaches intrinsic value, it's above intrinsic value, or you think your thesis played out beautifully and it's time to exit the position after a few years and move on. But the danger is that I think it may be difficult to make that exit decision because you feel too close with management. At least once, and maybe more in 11 years, I was in that position where it was a position in a company that started as a microcap, and later, for a variety of reasons, some of those were caused by the company, and some of those were probably good luck and tailwinds in the environment. The company became a lot bigger in terms of market cap, and share price appreciated very substantially. And at some point, I believe that that's the right decision to be exiting the position. The thesis largely played out. I think the company, unlikely to be even fairly valued, probably getting into overvalued territory. It's time to sell and move on. And it almost felt that as if I'm letting a friend down. And I wouldn't even call it I was friends with CEO, but we owned the position for a number of years. Maybe 3.5, something like this. This is from memory. And it felt I felt almost bad as a human being. This company and this management team have done great things at that point in time, and I am exiting. This feels almost I'm a bad human being for doing that. Like, you wouldn't do it to a friend, right? You will not stop being friends with someone else just because XYZ happened, unless they do something unethical which changes your opinion of them at the core, right? But here, gee, why I'm selling? So it felt really challenging psychologically. And I think that was the moment when I thought, I should never feel very close friends with management. Again, I want to be friendly. I want to be respectful. I like many CEOs of the portfolio companies where we invested. But I'm afraid to be friends.
Protecting yourself. You're protecting your heart. That's good.
I'm protecting my heart. I'm protecting my mind. I'm also protecting my portfolio.
100%.
Another thing is, as I got more experience running the portfolio and being responsible for the P&L, the more I think that managing yourself is probably the most important thing that you can do. And by the way, there are not that many things you actually control in investing and in the business in general, but that's one of the things that you probably do control to some extent. And that's, I think, very, very important.
Like, let's say there's only the IR contact that's on the press release or something, and you're saying, okay, I'll hit them up, but is it speaking with the chairman? Is it speaking with the CEO first? Who is it that you're ideally wanting to engage with when you're first saying, okay, this is interesting, I want to take a step further?
It depends on the company size. And as you know, I don't invest exclusively in microcaps and small caps. So if I invest in a larger cap company, I may initially get access only to IR, and then I need to jump over the IR and get a hold of CEO or CFO. Usually with smaller companies, I do not speak much with IR on a regular basis. I may check in with them about something, sure, and usually they're incredibly helpful about pointing me out in the right direction, etc., etc. But usually you have conversations with management. So that's number one. Number two, it depends on the nature of your questions. If you want to talk about a big picture strategy or go to market or sales motion, probably CFO may be the wrong person. Sometimes no, sometimes CFO may be incredibly knowledgeable about that. But for example, if you talk about marketing, okay, explain to me how you manage marketing campaigns and which channel is better. And I'm making this up, by the way, as we go. Are you going with Instagram or TikTok, and what's the differences, etc., etc.? CFO may not know those things very well, which is very reasonable. In that case, you need to adjust the questions. Similar, if you're speaking with CEO, don't ask them about why depreciation increased last quarter more than you expected. CEO may not know. And quite frankly, I almost think I would be really concerned if he did. Because why are you spending your time instead of trying to figure out how to sell more products to more people or how to build a team? Why you're spending your time on knowing why depreciation went up more than expected? So you need to calibrate those questions. And sometimes you may come away from a meeting with some of your questions not being answered. And that's okay. In that case, ask for a follow-up with someone who will be more knowledgeable about that area. So one thing, and this is a broader point, and not necessarily about the meetings per se, but about thinking and evaluating management, is understanding how coherent management team is and how deep is the bench. Because we, as investors, often think about management as CEO and CFO. Realistically speaking, there are, especially at bigger companies, again, not necessarily 20 billion company, but $500 million company, let's say, and some of those will be attending conferences like yours, Bobby, there are functional heads. There will be someone in head of manufacturing, if it's a manufacturing company. There may be a head of marketing. Guess what? Very important person. There may be chief revenue, head of sales. Very important person. As one of my business school professors at Stanford joked, in business there are only two problems. Number one, not enough sale. Number two, everything else. So that's head of sales, the chief revenue officer. Very, very, very important. And usually investors do not get a chance to talk to all of them for a variety of reasons. Sometimes we do get a chance to discuss certain things with those functional heads. Capital Markets Day or Investor Days or Analyst Days, one of those events where those people will often present. And you see them and you can see who actually makes a lot of important moves behind the CEO and CFO. I also mentioned understanding how coherent the team is very, very important. What I mean, there is one company in the portfolio, and it's a European-based company. So I think they may do their website differently than a typical American company. You go on the website, you will see probably top between 8 and probably 10 executives all listed on their website. So you can go and evaluate their background. Okay, that's useful. But what is also very interesting is that you can see how long they've been with the company. Guess what? If the key members of the team has been around for 5 years plus, and in the meantime, the management executed, and the company executed at a high level, it's probably good that there is continuity of a team. Now, if the results were horrible in those 5 years, I would probably say that maybe some refresh would be beneficial. Maybe. Another example, another company. I think the company has gone through a substantial turnaround over the last 2 years. And what is interesting, in my opinion, the company went through some really hard time. Again, I only studied that history. I wasn't following the company as it was happening, but with the benefit of hindsight, when you read the filings, when you read the earnings call transcripts, you get a feeling that, gee, this company has gone through some really big challenges. But then what is interesting is you look at the key members of the management team, and all of them have stayed through a turnaround. And again, I think, in my opinion, it talks a lot about the qualities of the CEO of that particular company. Because holding up the team together, when your share price is massively down and the business has some real challenges, that's not easy. You really need to be a good leader, good motivator, good at inspiring people, because otherwise your talented people could leave. They have other options. They have not signed with you a 10-year contract that they will stay and never leave. So keeping them is something that, in my opinion, speaks very highly of the qualities of the CEO.
So, Artem, what would you do in situations, let's say a company that you're looking at doesn't host an investor day, or maybe even doesn't do a conference call? What are some of your best practices there?
So in that case, for understanding that depth of management and the bench, how big is the bench, is LinkedIn is your best friend. Again, like the couple of those European companies that I mentioned, they make it pretty easy, but you just go to the website. But in many other situations, you go to LinkedIn, and usually C-level executives, C-1, so CEO -1, they usually will have LinkedIn profiles. Especially it will be true for outward focusing people. For example, if you're head of marketing, it will be highly unusual that you do not have your LinkedIn profile. By the way, if you maybe in that case you should not look into the company. I'm not sure whether the person will be good at marketing. Or similar for sales. Like if you're head of sales, most likely you gotta have your LinkedIn profile up and running. Otherwise, it will be more challenging. So LinkedIn is your best friend.
Absolutely. Another question that I have for you. When you're thinking back on your 11 years of experience running Caro-Kann, we were talking offline about how you've really focused more on managing yourself is better than managing everyone else. You also mentioned that earlier in our conversation today. In your opinion, what do you feel, aside from that, as being maybe your investment edge? What would you say is another investment edge that you feel is very important that you think others maybe should also consider?
Okay, so on investment edge. Okay, now we'll go with you on a tangent. I think investment edge is the most overused, potentially misused, and probably not very helpful and useful concepts out there. Because when you ask someone what's investment edge here, you either ask a person to say, I'm an absolutely arrogant human being who believes that on this company or this set of companies, I am the smartest person out there. Number one, it's difficult to be the smartest person out there. That's number one. Number two, even if you are and you say that, you kind of look like not a nice human being to hang out with and grab beer at a cocktail reception that Bobby will be hosting in June. So there is almost no way for you to answer that question in a way that will make it look good. So that's number one. Number two, we as investors largely operate with the same information. Or we could largely obtain the same information. Filings are public, earnings calls are public, many conferences are public, there are recordings, etc., etc. Then there is information that is out there, such as talking to customers. Most people do that. So if you just if you get 10 smart, diligent investors in the room, and you ask them what you've done on company XYZ, or even what they usually do, they will probably give you roughly same answers. We read the filings, sure. We read the earnings call transcripts, sure. We speak with management, sure. We speak with customers. We find some people who used to work in the industry, and we speak with them to understand how the industry works, etc., right? Now, I would suspect that out of those 10 people, 1 or 2 will know the company and understand company better than others. So it's not necessarily about the information that they got, because they read roughly same things or did roughly the same activities. It's the same, Bobby, as when funds come to different podcasts, including yours. I think most funds, there are exceptions, but most people who manage the funds, they sound fairly the same. Everybody wants to invest in high-quality management teams, in high-quality business models. Everybody wants alignment between management and public shareholders. Capital allocation is very, very important. Execution at a high level is critical. And everybody believes that they got downside protection and a lot of upside. And that's what people say. And have you heard of this game, Consulting Bingo?
No, but I'm going to order it right now on Amazon.
I don't think it exists on Amazon, but that was the joke. It's probably, joke is 20 years old or so maybe it's outdated, maybe it's still out there. And I think I heard this from a consultant, like McKinsey, Bain, BCG type of friends. So they will have list of words such as, alignment, unit economics, buy-in, stakeholders, etc. So that consulting speak. And then you write them down, let's say 10 words. And once at the meeting, all those 10 words were mentioned at least once, the game is over. And usually they will get up and say something outrageous, which will make it fun. That's kind of how the game played. So I think if you do the same for investing podcast, you will have the same 10 words, roughly, that everybody repeats. But how those people, myself included, execute on those words is what makes a difference. And execution will be different.
Right. No, you're pretty spot on. I mean, for the most part, that is, when I speak with most investment managers, that you can kind of paint with a broad brush everything that you just said. The part that gets interesting when it's trying to explain that, okay, well, here's how we executed. Here are the decisions that we made for our portfolios.
Yes.
And trying to put words to that execution, that's where you get the good stuff.
People.
That's very difficult. That's very difficult to do.
It's very difficult to do. And also different people will assign different meaning and different substance to some terms that are very commonly used. What is quality? What is high quality business? Now, there is some book explanation and book definition. It's a business with very high ROI, return on invested capital, ROIC, etc., etc. Not the only explanation, by the way. There are many, many others, and you can make it as complex as you want, but there are some standards in the industry. But at the same time, many things are fairly specific to a human being, to an investor. And also often its ability to visualize how something that may not necessarily appear, in quotes, air quotes, high quality today, actually either is already high quality, but it's not apparent, or it will evolve into high quality business 3 years later. So it's often not what is already on the surface and fairly easily identifiable. It's how it could look like in the future.
Artem, back in 2024, I'm doing a hard shift. But back in 2024, when we did a podcast together, you mentioned and we talked a bit about being skeptical about microcap even as an asset class, but that it's still a very good training ground because the feedback loop is shorter. Do you still feel the same way?
Yeah, I feel So let me step back because I don't want to assume that everybody who's listening to this podcast listened to our 2024 podcast. So that podcast came about as a follow-up on your question at the Planet MicroCap in April 2024 when you asked about, there were several panelists on the panel, myself included, and you asked about what's your non-conventional belief about microcaps. And I believe I said that many people talk about how microcaps or small caps in general, in quotes, bound to outperform large caps because for a number of years, large caps have been outperforming. And I said I don't believe it's necessarily true. And I explained that the market structure changed substantially. Companies go public a lot later, and most disruptive innovation happens in private companies, or disruptive innovation happens inside very large companies, and both features were not present if you go back to the period when small caps or microcaps tended to outperform. So that was the theoretical explanation, rather my hypothesis would be a better way to describe it. And again, if someone is interested in this topic, probably it was May or June 2024 when you and I recorded that podcast. So, and I think the question that you and I chatted before this podcast is, Artem, if you believe that way, why you're still interested in microcaps and why you're excited to do that? And few reasons. Number one, I believe microcaps are more likely to be mispriced. And as a result, I believe it's a better hunting ground. That's number one. And number two, which you touched upon, is that I do believe that microcaps is fantastic way to build pattern recognition and increase the number of reps. If you think about what we do, it's what we as investors do, it's a lot about pattern recognition. And you need to train those reference positions in your mind. Now, you can read, incredibly useful. You can read investment books. You can listen to podcasts with other investors. You can go read investment memos. Many of them are public. Many of them are on Value Investors Club or similar resources. And by the way, now, over the last few years, there was a big Substack movement, and many of them have very good investment memos. So you can learn a lot and help yourself build that pattern recognition by engaging in that reading. Definitely. But nothing will replace living through. And in my opinion, feedback loop in microcaps is usually shorter, and as a result, in the same amount of time, and I will use highly speculative and arbitrary numbers, that will take you, same amount of time, will let you see your thesis go from start to finish and either prove itself correct or prove itself incorrect in a large cap. In the same time, you may see several companies in microcap land. Either your thesis playing out or not playing out. And I think that's very, very useful. And that's how you enhance your pattern recognition building. For example, I think, look, COVID, there were many bad things about COVID and the pandemic. One thing that was good about COVID is that that was a great time to meet hundreds of companies a year and do hundreds of management meetings in those 2020, 2021, because everything shifted online. So you don't need to travel. You sit, to be clear, I like going to Vegas to a conference, Bobby, but not going anywhere. That was a fabulous thing in many ways. You wake up, you put your pajama, okay, maybe something more presentable. You get on Zoom, and then you go from morning until after lunch, just talk to companies. And there were a lot of events like that. Both conferences, non-deal road shows, investor relations firms were organizing various meetings. That was a fantastic way to learn about investing in general, but also to learn for myself what works in management meetings, what doesn't, get those feedback loops, and then hopefully improve upon them and have a playbook after doing that many, many times. To be clear, I did many management meetings before the pandemic as well, but that was training on steroids in many, many ways.
Dive deeper. Why would you say that was more training on steroids versus what then you were able to differentiate the two for, I guess you'd say, some of the main learning lessons and how you built the playbook? Obviously, you do the 10,000 hours and stuff, and you were able to really accelerate that during COVID. But talk to me more about, pre-COVID and that experience then.
For me, and I'm talking only about my experience, the number of management meetings during COVID went up several-fold. Partially because it just became all of a sudden a lot more convenient. There were several factors. Some of them specific maybe to me, some of them, or investors in general, some of them will be specific to society around us. First of all, Zoom really took off during the pandemic. In 2019, a typical management meeting still will be a call on some 800 number, and that will be a conference call. Zoom really started taking off and became an industry standard in 2000. So not in 2000, in 2020.
Right, 2020.
That's number one.
Now we're on Riverside. No, just kidding.
Yes, now on Riverside. Yeah. So that's number one. Number two, all offline conferences did not exist, so everybody got online. Number three, you don't need to travel anymore, so you save a lot of time on simply traveling, checking in to the hotel, boarding on the plane, flying, waiting for your luggage, etc., etc. Just became a lot more efficient. And then all of us were stuck at home with nothing to do. No movies. I mean, you couldn't go to a movie theater. That's what I mean. You don't really socialize with a lot of your friends. You don't go to a restaurant. You don't go to a bar. You're pretty much stuck at home. What do? Okay, you meet hundreds of management companies.
Well, you can't meet your favorite CEO friend, for a beer.
Oh, no.
Who's your friend? Yeah. Who's your friend now? Because when friends, you go, you can go get a beer. Yeah, absolutely. I mean, look, it makes, I think there was a lot of folks that felt very similar to you that 2020 time period definitely accelerated the learning curve quite a bit. You were asking me that you brought this one up beforehand, and I thought this was a really cool question and topic for us to discuss here. What are you most afraid about when it comes to your profession and your investing style, and why? What are your fears, concerns?
I'm afraid of becoming intellectually rigid. And sometimes you look around and you look, and some people, they keep learning and improving many years into the profession. And you look at some other people and you, rightly or wrongly, perceive them as being stuck in their own way. And that's what I mean by intellectually rigid or intellectually inflexible. And there is a very fine line that one needs to walk between passing on ideas fairly fast because they don't fit into the way you like and know how to invest, and being intellectually rigid or inflexible. And it's tough. I'll give you an example. Few years ago, maybe 2, maybe 3, one of the investor relations firm who has a number of clients, and over the years, I met with a number of their clients. And I believe they represent pretty interesting companies. And usually I'm happy to, when they land a new client, I'm usually happy to do virtual non-deal roadshow and meet that company and learn about their business. And they offered me to meet with their new client that was in energy space. I don't really invest in energy. I don't have a lot of background knowledge. I don't have domain expertise or what Buffett's accolades will call circle of competence. So I said, look, thank you for the offer. I appreciate it. I don't think it's my cup of tea, etc. I'm not 100% sure, but I believe the stock probably has been a multibagger. Now, part of that is the demand for AI, etc., etc., etc. So, but was I intellectually rigid for declining the meeting? Or was I following that I don't really do those type of investments, I don't have a lot of knowledge, I will allocate my time on pursuing other investment opportunities that are better fit, likely, for my style and for my knowledge base? I don't know the answer. Now, I do know that I am mad at myself for not meeting that company. I don't know whether I would have invested or not. There is no way of knowing. I may have met the company for 30 minutes and walked away thinking, oh my God, I got no clue what they're talking about, and it was 30 minutes or 60 minutes of wasted time, or largely wasted time. That's possible. Maybe it would have sparked interest in me to go and do more research and build that expertise. Because if you think about it, and this is oversimplistic assessment, when I started Caro-Kann Capital, I knew something about investing, and I knew something about various industries, sure. But over the last 11 years, I've learned a lot more about various industries, whether it's businesses with a strong network effect, or whether it's e-commerce, or whether it's marketplaces, or whether it's software, etc., etc. I've learned a lot over the years. So I was not born, or even I didn't start Caro-Kann Capital with that knowledge base. I built it over time. So was it dumb of me not to try, not to do that meeting and potentially decide to learn more? I don't know. It's an open question, but that's what I'm afraid of on a bigger scale, becoming intellectually rigid and not flexible and not learning new things.
I mean, if I may, unsolicited, my impression of this,
What?
I don't think it's intellectually rigid at all. I feel like it would be more intellectually rigid if, let's say, you were brought an idea that person or that let's say it's an IR firm that brought to your attention that they know is within your circle of competence, and you were like, no, because you're just there's a couple things here that I know this business too well. I can quickly assess, and that I don't want to take the meeting. I feel like that would be more intellectually rigid than maybe saying no to taking a meeting with a company that is completely outside your circle of competence. Because even then, you have to make the assessment for yourself of, all right, well, it's okay. This individual company is, they're going to say all the right things, right? They're probably talking about the next best things to slice bread. Okay, I have my BS meter and I can tell all this, but it's still going to require so much more work on the back end to better familiar yourself with. So it's not necessarily intellectually rigid. It's just you haven't practiced that tool to make what you would probably assess the best investment decision possible, because you're so experienced in this other things that you are competent in, that you're like, it's not necessarily rigid. It's just more like, it's just, how do I properly allocate my time?
I appreciate you being my defense attorney in my own eyes.
I thought I did a pretty good job, actually.
You did pretty well.
Yeah, I mean, don't beat yourself up. So you missed a multi-bagger. Big deal, you know? There's always another one just around the corner, right? That's fine. I mean, is there anything else that you have fear of when it comes to your profession? I mean, I think most people are listening to this and probably laughing out loud, thinking like, "Wow, yeah, Artem's scared of being intellectually rigid." Okay, Artem, we're all worried about you, like being so locked in on this. I would honestly argue that's probably the least thing I'd be concerned about if I were you personally. But I appreciate that's something of concern for you, having known you this long.
Well, Bobby, maybe you think that I should not be concerned about that exactly because I've been concerned about that.
All right, we're going two levels too deep for me.
Yes, we're going deep. It's true.
Like we said, you're celebrating 11 years here. I've said that multiple times today. What would you say have been some of the lessons or the biggest lessons you've learned over the years when you think back to all the things you've experienced since running and founding Caro-Kann Capital?
You know what is funny? Most things that come to mind are things that that I probably read or heard before, but you need to live through your own experience to fully embrace them. And then when you look back and you think, gee, haven't I read that in this book or this Warren Buffett letter or this investor letter or something? Like, why did I need to make that mistake myself to fully learn or relearn that lesson? Like, for example, Usually bad managed teams continue to surprise to the negative, and good management teams find ways to surprise you on the positive things. Business model matters. If it's a bad business, it's unlikely you're going to make a lot of money as an investor. There are exceptions, don't get me wrong, but usually. So many things when you look back, you see like, gee, really? I was so dumb 11 or 10 or 9 or 8, whatever years ago. Like, I've read about it. Like, why did I make this mistake myself? So now again, some mistakes are probably avoided because of reading and learning, but some I probably needed to repeat and like, yeah, what I've read here probably true. Sounds like it's now I just proven that point.
What do you imagine the next 11 years to look like? What would you like them to look like aside from continuing to have, amazing performance and all that stuff?
Look, I think eventually what we do is making judgments as investors. And I'm hoping that with years, I've become better at making those judgments, and I hope to continue to improve. I think now, historically, a lot of work in investing consisted of fairly tedious tasks. Think about collecting certain information from a variety of filings, or going through 20 earnings calls for a company, which is roughly 5 years, and trying to get certain things out of them. And that's very important ingredient of your process and your work. But realistically speaking, it's not your output. Your output is your decisions that ultimately should lead to returns, whether good or bad or somewhere in between, depending on how you do. But a lot of inputs were taking a lot of time, and some of those elements were a little tedious. And I think now with all research tools, we as investors can be spending a lot more time on very interesting and intellectually stimulating things, because a lot of tedious things can be done by modern AI tools. And then you're left with a lot more qualitative assessments of management teams, of customer value proposition, of engaging with customers and learning about their needs and their pain points and the value proposition for them that the company creates. And I think that's a lot more fun than collecting data points about why, making this up, gross profit margin behaved in a certain way and getting that out of the last 3, 4, 5 years of financials and earnings call materials and figuring out that mosaic. So that part excites me.
That's pretty cool. I'm going to ask an annoying question, but I think it's a good one to close us out here. March 2026, got a full year ahead of us. What are some of the things that have been most interesting to you as you've been getting, starting to stretch out? We got the first 2 months under our belt. What have been the couple things that have been most interesting to you when you're looking ahead for the rest of 2026? It can be anything. It could be an investing thing. It could be strategy. It could be, a book you just read. What are some of the things?
Okay, on the investing side, I don't think I necessarily treat January and February as the first 2 months of the year as any different that I will treat March or April or the way I treated November and December last year. So I don't think it really matters. So now we're going through the Q4 earnings. As we pretty much speak, they're playing out almost real time. Companies are reporting now because remember, smaller companies, as you very well know, tend to report a little later than the big ones. So we're still going through that motion right now. Probably will be done in the next 10, 14 days. I'm sure everybody talks about software as a service and whether AI gonna kill it. It has been interesting, especially when you don't have that much exposure to software. So it makes it a little bit more interesting to watch than probably if you had a lot of exposure to software, that probably would be more challenging. So I I don't think I necessarily have a good answer, but you asked me about like maybe a book is something you already know interesting. So the one I just picked a few days ago is the book by very famous and super successful VC investor, Bill Gurley. And he just I believe it got published literally within the last few, I don't know, 10 days, a week, very, very recently. I can't be mistaken. It's called Running Down a Dream. It's actually not about venture capital investing. I think it's more how to find fulfillment in your profession, or rather, how to find a profession that will give you fulfillment. I think I have a lot of fulfillment in what I do. So even though I have not read that book when I was making those choices, but it's a great book. I probably wish I read it when I was 17 or 18, but I have a 4-year-old son, so I think it will be good for me to read that now and remember the lessons when he grows up. But it's also a great book. There are several fantastic profiles of highly inspirational people in various fields. That's fun to read. And then the author, Bill Gurley, again, he was one of the co-founders of Benchmark, which is an incredibly successful VC firm in Silicon Valley. They have many, many, many successful investments. I think they were among probably more relatively recent ones is Uber. They were very early on and very big in backing Uber. So, and he also shares a lot of his own thoughts on this topic. So I'm enjoying reading that.
At first when you said it was called Running Down the Dream, I thought, oh, he's reading a Tom Petty book. Oh, that's pretty cool, Well, sorry, come on. Well, music nerd now, the Running Down the Dream, Tom Petty and the Heart. Okay,
Okay, that cultural reference completely misses me, probably because I did not grow up in the US.
Fair enough. Well, Artem, we've covered a lot here today. Final thoughts? Anything else you want our audience to know, be aware of, should really be looking closely at? Anything else that we missed?
No final thoughts, but I look forward to seeing you in Las Vegas in June.
Same here, man. It's going to be so fun. Well, Artem, where can our audience go and find more information on Caro-Kann Capital?
I have LinkedIn profile. As I mentioned earlier, LinkedIn is a useful thing when you want to look up various people working at companies that you're interested in. There is also a website, Caro-Kann There is two hyphens actually, between Caro, CARO dash KANN dash capital.com.
Yep. You got it.
Sometimes now with the benefit of hindsight. Okay, there are two things that I realized with the benefit of hindsight after running Caro-Kann Capital for 11 years. Number one, do not start on March 1.
Why? Why not start on March?
Because your anniversary doesn't nicely fall on a quarter ending.
Oh, right.
So always this in the middle. And when I write quarterly letters, they're almost always quarterly. So as a result, when it happens, March 1 is your birthday date, it's very awkward. So like, don't do that. Number one. Number two, I really like the name Caro-Kann Capital. That's why I chose it. It'll be really strange if I said, oh boy, it's a horrible name. What did I do? So I really like it. Liked it back then, still like it. But, boy, it does sound very foreign. So, and then you need to spell it, etc., etc. And the number of times how sometimes it may be misspelled, it's wonderful. And when you pair up with my first name and last name, which also fairly foreign, then it makes things even worse. By the way, true story. At Planet MicroCap in 2025, in April, there was Microcap Club organized a series of stock pitches where investors, about 10 I believe, would get on stage, present a company that they really like. Well, obviously with all appropriate disclaimers that it's not investment advice, etc., etc. So, wonderful event, really enjoyed it. And I was one of those who also presented an idea. Later on, another investor who writes a Substack, wonderful Substack, got interested in the idea we do a call, and then he says, I will write a Substack post on that one, and I would like to give you a credit as a person through whom I found this idea. Are you okay with that? I said, okay, it's very nice of you. It's very kind, sure. Then a friend forwards me that Substack and says, hey, you're given a credit there, FYI. Oh, by the way, your name is misspelled. So in my first name and last name, there are 10 letters. I believe there were 3 mistakes. So
I'm trying to think what they could be. What, like an I instead of an E for Artem, or
it's probably I, and probably
an E instead of an I for Fokin,
E instead of I, like something like this. But I'm like,
PH instead of an F, maybe.
No. That was not. Plus, that would have increased the number of letters. The number of letters was correct. It was just different ones. So out of 10, there were 3 mistakes. So I joke that, hey, in investing, it's considered that you're good if you're 60% right, 40% wrong. It was 70-30. It's pretty solid. So, but I did email the author of the Substack, and he kindly fixed the mistakes, but it was very funny.
That is quite funny. He hit it 70%. I really hope he made did quite well on the ideas as well. It would have been funny if if the idea didn't work out and he just lost it. He's like, I'm not changing your freaking name, dude. You are forever going to be 70% Artem Fokin.
Yeah.
Well, Artem, it's been a pleasure as always. Thank you for joining me. I always enjoy our conversations, and I'll see you soon.
Thank you, Bobby. I'll see you soon in Las Vegas.